Hey, it's me here with a research report on Omada Health, a stock that I've had my eye on for a while now. We'll cover the business overview, recent IPO, competitor analysis, moat, financials, due diligence concerns, and outlook. So let's get right into it. 1. Company and value proposition. Omada Health is a digital-first virtual care provider that helps people with chronic conditions manage their health. They offer a range of products from programs for diabetes, hypertension, and musculoskeletal or MSK care to support for patients taking GLP-1 medications. Their newest offering, 𝗕𝗓𝗪𝗧𝗪, uses AI to help people keep track of their meals, hydration, and progress toward goals. By making small changes over time, Omada helps people build healthy habits to prevent or delay the onset of costly complications between clinical visits. They work with more than 200 health plans and employers to reduce healthcare spending while improving quality of care. 2. Market niche and landscape evolution. There's a strong market pull from over 150 million Americans living with chronic diseases. An aging population, the rising adoption of GLP-1 weight loss treatments, and wellness-centric employers all contribute to this trend. On the tech side, digital therapeutics have matured to a point where Omada's digital care model combining human coaches with AI-driven tools is well-suited to serve as a peripharmacy adjunct to GLP-1 drugs. Real-world evidence shows that Omada's diabetes prevention program reduces progression risk by around 25% over 2 years, with gross savings of $3,900 per patient at month 36. Their quarterly gross margins exceed 60%, while net losses are narrowing. 3. Competitor analysis. Hinge Health, which went public recently, is a digital MSK-focused platform. Pros: specialty depth in MSK, weakness: narrower therapeutic focus. Then there's Livongo, now part of 𝗕𝗨𝗬𝗜𝗓. They focus on remote monitoring of chronic conditions. Omada's advantage: wider range of conditions, payer, plan first go-to-market strategy, and claims billing infrastructure supported by an AMA Category 3 code. Finally, larger health systems and health plans are developing in-house digital solutions. While this remains a threat, it's also an opportunity to collaborate. For more detailed comparable company analysis, check out the full report. 4. Moat and payer strategy. The moat is quite low with no proprietary therapeutics or patents. Instead, Omada relies on clinical validity and strong payer-provider integration. To access this market, their go-to-market model is deeply integrated with payers, PBMs, and employers via value-based contracting and claims billing infrastructure. Retention is strong with 90% 3-year customer retention and over 2,000 beer relationships. However, revenue is concentrated, with one Cigna-affiliated payer contributing 60% of Q1 2025 revenue. This concentration is somewhat mitigated by the payer's own diverse customer base, but it's a risk to watch. On the positive side, Amazon recently selected Omada for its virtual care service, demonstrating interest from large enterprise partners. Additionally, Omada launched its nutrition track with the AI-driven 𝗕𝗓𝗪𝗧𝗪 ahead of its IPO launch, signaling ongoing investment and engagement. Securing an AMA Category 3 claims code supports scalability via claims billing, though reimbursement rates are uncertain. 5. Financial and valuation overview. In 2024, Omada reported revenue of $169.8 million, up 38% year-over-year. Q12,025 revenue was $55 million, up 57% year-over-year. Gross profit margin is around 60%, and the net loss has improved from $19 million in Q1 2024 to $9.4 million in Q1 2025. See Fierce Healthcare and Reuters for more details. The IPO took place on June 6, 2025, at $19 per share. On the first day, shares opened at $23 and reached till the $28.40 intraday, implying a market cap near $1.8 billion. Around 7.9 million shares were sold, raising roughly $150 million. See Reuters and Business Insider for more IPO details. Based on this valuation, the price-sales ratio is initially approximately 20 times trailing revenue. Reportedly, the multiple has since dropped to 6 to 7 forward PS, which is still rich relative to peers like Livongo, which was last valued around 40 revenue before being acquired, and Hinge Health, which is currently trading at approximately 40 times revenue. 6. Recent developments and due diligence. The IPO filing revealed heavy revenue concentration, with two payers contributing 60% of Q1 2025 revenue. As mentioned earlier, Amazon has selected Omada for its virtual care service, indicating interest from large enterprise partners. The launch of 𝗪𝗏𝗥𝗧𝗏 before the IPO also demonstrates continued investment in AI-driven engagement. Additionally, securing an AMA Category 3 claims code supports scalability via claims billing, although reimbursement rates remain uncertain. 7.5-year forecast and DCF outlook. Assuming 30 to 40% annual growth, revenue could reach beyond $800 million in 5 years. Gross margins are maintained near 60%, and operating break-even is achieved by year via scale efficiencies. With a discount rate of approximately 12% and a 30% downside risk probability factored in, the DCF fair value is in the mid-20s per share. In a bull scenario, continued execution drives shares to $25 to $30 in 5 years. In a downside scenario, if growth stalls or profitability is pushed out, the valuation contracts below to PS or below $10 per share. 8. Key catalysts. Q2Q3 2025 earnings reports will provide insights into revenue acceleration, margin expansion, and 𝗪𝗏𝗥𝗧𝗏 performance. Contract wins outside of the Cigna partner concentration, especially with Medicare Advantage, Amazon, and Veterans Affairs, would be positive. Clinical endpoint publications or new value-based payer partnerships could boost confidence in the efficacy and reimbursement for Omada's solutions. Favorable policy or regulatory advancements, including those regarding digital therapeutics reimbursement, could also drive interest. 9. Risk-reward and recommendation. At approximately 20 times revenue with no visible moat, the stock appears overvalued. Given the execution risk, the shares might be best suited for patient, risk-tolerant investors seeking growth. Staggered entry after proof of margin improvement and revenue diversification could optimize returns. Downside protection can be achieved by entering through structures tied to operational milestones or a potential contingent value rights agreement, which could help capture upside while limiting risk. Overall, prudent investors might wait for signals of execution, such as substantial diversification and a pivot to profitability before fully committing due to the aggressive valuation. Thanks for watching and see you next time.